Welcome back to Everything Money. We're glad you joined us again. It's Seth, Paul, and Mo, as always, talking to our subscribers all over the world, our dear patrons. You know we love you. Today we're talking about NVIDIA, this chip provider, Paul. I mean, when we bring up the idea of chips, and it is a dogfight. People are so adamant about their belief in different companies when it comes to these chips. I mean, it's like that in crypto, or like there's like people literally going to war in the comments about which is better. They're very, very interested in these type of companies, Paul. And what we're going to do is use our 8 pillars to get an update on the NVIDIA stock price, its fundamentals, look at some new earnings, and see, is their stock price justified? Is it over or undervalued? We will get all of this from the prognosticator that is Paul Gabriel and Mo. Welcome in, Mo. Fresh off a lift, I see. You're just doing push-ups in your spare. Go ahead, Paul. Tell us about NVIDIA.
He does push-ups while I talk, by the way.
I hear him huffing and puffing over there.
All right, guys, NVIDIA is a big company, almost $500 billion, $489 billion market cap, 92 PE, that's an X, and profit margin of 27.7, that's a check. Guys, going forward, we're probably going to start looking more at 5-year PE because we like to look at longer term. So, and then 1 year at a time, you can have aberrations that happen here and there. But right now, the 1-year PE is 92, which is still quite expensive. Guys, you know how much I love my adorable dividends. 0.1% dividend yield. Can we verify that? 396 million paid.
How cute.
Now, the great thing is free cash flow seems to be growing. $5.5 billion last year versus $3.5 billion average over the last 5 years. Guys, very important for us. Return on invested capital is over 10%. Over 9% in the last 5 years. Return on invested capital is important. If you have two companies that make the exact same amount of money, exact same revenue, one has a higher return on invested capital, you want that one because it shows they deploy their money to make more money at a more efficient rate. Okay, so that's very important.
If looking at these numbers resonates with you a smidge, this is the gist of our channel. If you're new and this is the first video, before I met Paul, I was investing simply on ticker symbols. So I would say, I like this company, I'm going to buy it and hope it goes up. If you've been doing that, and this might speak to you looking at actually the fundamentals behind what a company makes. Keep going, Paul.
All right, so revenue growth, $7.5 billion to 19.3. Now keep in mind though, Seth, there were big jumps along the way. I don't know how much of this is from acquisitions versus growth. We can look at that in the cash flow statement, but last year alone, it went from 11.8 billion to 19.3. But it's still a check mark nonetheless.
How about profit growth? Pillar number 4, Paul.
2 Bizzle versus 5.3 Bizzle. Check mark. Bizzle, by the way, is short for billion.
That's new for you. That's very, very trendy. You just started that right now after 800 videos.
Oh, they definitely made an acquisition because look at our shares outstanding.
Okay.
592 to 2.5 billion. So they definitely use shares. By the way, I love the fact they issued shares in a very expensive company to make an acquisition. They're showing that, hey, we think our stock is overpriced. We're issuing shares to somebody in order to buy a company at 90 times earnings. We're like, hey, you can take this stock. It's super overpriced. We're basically not paying, a huge number for this company. So also still an X though, balance sheet. Now, one thing though, Seth.
Go ahead.
We talk about the software. The software is wonderful. If you like the software, you can get it. It shows you all the 8 pillars for you. We're going to skip ahead. Shows you all the stuff. You get exclusive content. Let me show you exactly what you guys get by signing up for us. 84 cents a day, mobile app, 8 pillars, 30 years of financial data, exclusive content, stack analyzer tool, real estate calculator, access to us 3, retirement calculator, Discord community. There are over 5,000 people in our Discord. You can go in there, talk to them about any investment ideas you have, talk to them about life. We have people who tell us they're engaged before they tell their family they're engaged. We have people who told us that they're going to lose a relative they hadn't told anybody yet. I mean, this is a very tight-knit community, and it's only 84 cents a day. If you sign up, you're locked into that price. Our competitors are $200 a month, $200 a month, $35 a month. This is the best value play you'll have. So going forward.
If you feel alone in your investing journey, join the Patreon. Click the link below, and you can join our community and talk with like-minded people. Paul, NVIDIA just did a recent stock split.
4 for 1.
And so what is it doing to shares outstanding?
Well, that doesn't change shares outstanding for the investor.
Sure.
It does change the overall shares outstanding, but I'm going to look at the last year, 2.46 billion. So they're very minorly increasing their shares outstanding. It's not even worth worrying about dilution for them, but they are slightly higher on the shares outstanding.
Okay, so let's go to pillar number 6, which is current assets over current liabilities.
18 billion versus 4 billion. And in fact, they have total liabilities of 12 billion, which means, guys, they can take them, basically the cash equivalents in their account and pay off all the company's debts. That is awesome. It's amazing. I love that.
How about the free cash flow growth, which is pillar number 7?
The big mamma jamma. Guys, part of the software is I added this line of free cash flow, so you don't have to do the math yourself. 1.46 billion
Wow.
to 5.5 with an average of 3.6. 3.6 times 20 is $78 billion.
Come on.
Nope, $72 billion.
The current market cap is 489 billion.
Yeah. So guys, and look at the PE, 90 PE.
Yes.
It makes sense that the stock's got to fall significantly in value to justify a normal PE. Now, what we're going to do though is we're going to go look at the stock analyzer tool once Mo is done, because the stock analyzer tool that's part of our software will allow you to make assumptions on growth rates, profit margins, free cash flow, PE, and tell you what you should pay for the stock based on your desired annualized return. Okay, so while Mo's doing that, I'm going to set up the stock analyzer tool.
Mo, let's go over and see if people are trading NVIDIA in the beautiful bid and ask nation. You know, I love those bid and askers.
So NVIDIA is one that the bid and ask nation has been on for a long time. So they got this thing back in March, right when it came up through the sweet spot, and people caught this entire run, which is awesome. Kind of settled down here for a little bit, and then it did a little sweet spot reversal, and we had people catch this entire run up. It was incredible. I think it was one of the best trades that people in the bid and ask nation have made. Now, right now, it's kind of just going sideways. It's kind of teetering right on that overbought area, and you can see the last time it did that, it just dipped below into the sweet spot in the negative direction, and it just consolidated sideways. So I expect that it's going to probably do that again unless we get some kind of shift in the overall market. Now, the thing that I want to point out,
Go on.
they did a 4-to-1 split on July 20th. And July 20th is about right here. And typically when the splits to me are kind of for the psychology, and you would think that the volume would increase because because technically it's a cheaper purchase price. And look at the volume over that time. It's actually declined. And we're sitting right at the 25-day moving average now. So the split didn't go, as I assume, planned for the company. But yeah, just keep a watch on it. Keep a watch on this thing. If it goes and makes new all-time highs, you can go for it. I think this will eventually be a good swing trade. This is a great stock to day trade, though, because the volatility is there.
So, Paul, we're now going to use our stock analyzer tool. This is a part of the software you get at being a patron. And when we move off Patreon here in the next month or so, you can get access to the software to determine what we should be paying for this company and all the companies.
Well, you can get access to the software today by joining our Patreon
that's
as
true,
well.
Paul. Sorry about that.
So guys, here's a confusing one for NVIDIA. So we went back to the cash flow statement here. If you look right here in acquisitions, they made an $8.5 billion acquisition last year. That's going to drive up revenue. So when you look at our stock analyzer tool, it shows a massive increase in revenue. You cannot assume that revenue increase because it took an acquisition to do so. I always do my stock analyzer tool, my revenue growth, based on natural growth itself. Because acquisitions can always happen. They can always sell, whatever it is. I look at natural growth. What number is that? I don't know. What you need to do is, if you really want the most accurate number, go do some research on what their previous year's growth were without acquisitions or dispositions. Now, I'm just going to assume 4, 6, and 8% for low, middle, and high. For share change, I'm going to assume 1% increase, 0.5% increase, and keeping the same. Profit margin, 24, 25, 26. Pre-free cash flow, 26, 27, 28. Now, guys, PE.
Yeah.
The current PE is 92. I'm putting in 12, 15, and 18. Why is that? The larger and larger the company is, the smaller the PE is. Why? The chances of a $500 billion company going to $1 billion is a lot lower than, and a lot harder than a $1 billion company going to $2 billion. So it's going to be harder for them to grow as a company naturally with as much revenue and profit as they do. Now, is this right? I don't know. And I'll show you how these assumptions still change things. I put my desired return 15, 12 and a half, 10 like I always do. Analyze, guys, massively overpriced. And it matches. PE is 90 and the stock price is 200. Just to get to the high level, it's got to fall by 80%. You might sit there and say, Paul, you're being too conservative. Okay, let's go up to the top and change all these numbers. I'm going to go to 8, 10, 12% revenue growth. I'm going to keep all shares the same. I'm not going to issue any more shares. In PE, I'm going to do 16, 20, and 24. Return, I just want to match the market. Look at this.
Oh, boy.
It's still massively overpriced. That's my point, guys. It's possible to overpay for hype and growth. It's very, very possible. I just went and changed these revenue growth numbers to numbers that I just don't think they made 19% revenue growth a year over the last 10 years, and that's with a big acquisition along the way. I just don't see NVIDIA being a company that. So the question you have to ask yourself is, what do they have to grow at for them to even justify the current price on a 7-year analysis? The first one I get is based on a 30% annualized revenue growth number, and you barely squeak in on the very highest of highest prices. That's why I like the stock analyzer tool. It allows you to make assumptions and see how unrealistic that some growth rates have to be in order to justify the current price. And if you're not doing this, it's like going in a ship without any map. You have no idea where you're going. It's like driving on the freeway. We don't know what exit we're getting off of. You have to have some guidance to sit there and say, am I just overpaying? Because at the end of the day, it's just math, guys. Every investment is the present value of all future cash flows. That's what we're trying to do here.
This is described in our new favorite book, Richer, Wiser, Happier. All the most famous investors who've ever lived have the same mindset. Some of them, Paul, they straight up say, they look at a company and just say, is it cheap? That's my first caveat. Is it currently cheap? And this is...
And they look in a matter of 30 seconds.
That's right.
25 to 30 seconds.
Yeah, so this company at the moment is not cheap at all. And so it's an avoid for us, like most of our stocks. But again, we implore you to think, what am I avoiding? What are the masses saying that I should probably avoid? and where can we find those misnomers to make great disciplined investments?
Yep.
That's our channel. Fondle a thumbs up. We'll see you in the next video.
And follow us on Instagram.
Oh, yeah. Follow us on Instagram. And by the way, Paul, we're giving away another Tesla and 100,000 subscribers. If you join the Patreon, you're automatically entered to win one of those Teslas. We'll be giving that away this fall.
Yep.
Thanks for watching. See you guys.